Hey everybody, Lee Lowell here, smartoptionseller.com. Today is Saturday, August 22nd, 2020. Hey, if you're an option trader, specifically an option buyer, you're going to love this video today because I'm going to tell you the three biggest factors that can be a detriment to your option trading if you're especially an option buyer. So stick around. We'll talk about the three biggest enemies to option buying. So what are we doing today? Welcome to another edition of the Saturday Synopsis. We look at the charts, see what happened over the last week, and give some insight into what could happen in the week coming forward. And then we go into our options trading education. Free education. I like to help people out. Been doing this in the options trading world for 30 years now, so I like to impart some of my experience and knowledge on you. So let's take a look at the charts today and see what happened over the previous week. Open up the chart here. Always start with the SPY. Exchange traded fund that tracks the S&P 500. I think you might see, if you track the markets, the S&P 500 rallied all the way up to its all-time high and just basically eclipsed its all-time high just by a hair, by a fraction. Made new all-time highs this past week. It was a big deal for us nerdy chart watchers in the market. So here was the last all-time high back in February, right before coronavirus started. Big down move, V-shaped recovery, S&P 500 tagged all-time new highs this week, just barely. I had this resistance line up here for the last couple videos. This is what we call a double top right now. We can make a major top here, big down move, and then we come back up to the top. So this is what's called a double top. A lot of chart watchers watch this. Sometimes this could tell of a final top in the market. A lot of people think double tops now lead to down moves in the market. Sometimes we get triple tops. So we don't know yet what's going to happen here. Let's bring this down a little bit. The market has been strong. There's been no stopping this market. So why would we think all of a sudden, just because we made a double top, that all of a sudden we're going to start coming off again? We may see some more sideways trading here. We're letting the market digest this massive major move back up to all-time highs. So once we get to a double top and after a major big move, we get some meandering. It may take a little while to pop through this thing here. Most of their earnings are done now for Q2. So what are we going to focus the attention on? We're still in the summer, the dog days of summer. Trading's a bit slower. Volumes contract a little bit. So I'm thinking we may see some meandering around up here at the tops. The bulls are not going to give up this move so easily. The bears are, they want this thing to go back down. They're going to claim double top, double top. We got to go down. I'm not so sure about that, especially since here. Let me just show you this one thing. So this is the SPY. Now let's actually look at the S&P index itself. This is the SPX. This is the actual index. So we still have let me draw a line here. We still have the major double top right here. But the index itself eclipsed the all-time high just by a fraction, a little bit more than the SPY itself. So we got the V-shaped recovery and the double top. If we all had just gone to sleep for 6 months, we would never have known any different, right? If we fell asleep here, woke up 6 months later, here we are. No big deal. We're still at the highs. We would have missed all this calamity. We would have missed getting freaked out and stressed out. We probably wouldn't have sold out of some of our positions. So that's why we always stress invest for the long haul, because you know why? Then you don't have to worry about things like this. The market always comes back. The market always finds its way back. Let's take a look at the NASDAQ, as that's been the strongest of the three main indexes: the NASDAQ, the S&P 500, and the Dow Industrials. NASDAQ. This looks more like a check mark, right? Check. Power bull run, check. So NASDAQ just powering higher, still going higher, still making new all-time highs every week, it seems. There's our trading week right here, the last 5 days. Finished on another all-time high. Check, please. Let's go to the Dow Industrials, which is the laggard of the three main indexes. Still doing well, still having in the V-shaped recovery. We talked about this in last week's video. Looked like we've been making a little bull flag here, right? We've got the flagpole, which is the upwards move until you start to see the pennant. Here's the up and then the pennant. So typically, like I said last week, the next move out of the pennant is typically higher. in the same direction from where it came from. So it came from down low, it's moving up. We got the flagpole, which is more of the line here, and then the pennant. And then the pennant usually blasts out to the upside. So the Dow Industrial still has a little more work to do to hit all-time highs, but it's following in the tracks of the S&P and the NASDAQ. We look at the VIX as well. Always look at the VIX because we are option traders, so volatility plays a major role in options trading. VIX still on its V-shaped upside down V, moving down, moves inverse to the general market. Still down below all of its moving averages here. Pop back up a little bit towards the end of the week. That's just more of the market kind of consolidating. So you'll get some up and down moves in the VIX, but as long as the general market is going up, the VIX will go down. So the consolidation here is sort of what we saw in the S&P 500, and the VIX is calculated off of the S&P 500. So you'll see these last couple days, the range has been pretty tight, so the VIX would be pretty tight as well. But the S&P 500, the next major hurdle, of course, is getting through the 339.5 level or 340 level. That's basically the line in the sand. So we want to see the market pop through that and move along with the NASDAQ. Now, the NASDAQ's been so strong. Why is that? Because there's a handful of major players that drive the whole NASDAQ itself. There's 5 or 6 stocks, maybe 5 stocks that power at least a quarter of the whole NASDAQ itself. And we will look at one of those today. Of course, Apple. Apple's just massive, major mover. Look at this power move, right? This was yesterday, Friday, August 21st. Had a $25 move, daily $25 move. Opened on the lows, finished on the highs. That's just some strong market action right there. Here's where earnings, the gap right here, earnings announcement, did very well in earnings and announced the 4-for-1 stock split. Once that was announced, off to the races. Now, we thought when Apple was at 400, a 4-for-1 stock split would make the stock $100 a share after the split. Now we're pushing towards $500 a share. Stock split will make it about $125 a share after the split. Just strong. Its counterpart, Tesla. Same thing. Looking at Tesla here, and it just had a momentary loss of internet connection there. Tesla, same thing as Apple. Look at the moves here. They announced their stock split as well, 5-for-1 stock split, and it's just gone powering higher. So these big stocks are taking up a chunk of the NASDAQ itself, so they're powering that index higher. Tesla doing really well. So it's hard to want to short these things. I know a lot of short sellers want to get in front of this thing and try to sell this thing down, but they're just getting hammered. Don't try to short this thing. It's got momentum behind it. So Tesla moving the market, Apple moving the market. Let's take a look at Amazon real quick. Amazon still doing well. It's been hugging the 20-day moving average line. And as we're seeing, once it pulls back to the 20-day moving average line, pretty good place to try to get long. Same thing here. It meandered, 20-day moving average, tagged it right here, and then boom, powered higher again. So Amazon also flirting with all-time highs. So you've got these monster behemoths in the tech market that are driving the NASDAQ higher. So that's it for today on the chart watching. Let's see what else we have here. Before I move into the options trading information, I just wanted, some people ask me, what are we doing in our newsletter, Smart Options Sell? We sell put options. So some of the things that we do, some of the things we look for on the charts, because people are asking me, what are your price patterns? What are you seeing on the charts that tell you to get in and out of trade? Well, I can't give you too much information here because it's not fair to the paying customers. But, some of the things that we look at, we were involved in some put sell trades on Cisco. It's one of them. And then when Cisco had its move down, we get out of that trade. We buy back the put option because when stock prices go down, put option prices go back up. But we were actually able to take some gains on our Cisco put sell trade because we sell way out of the money put options with strike prices way down here, way below the current price of the stock. So it gives us a buffer in case things like this happen. So we we didn't get hurt too badly. We actually made profit because we sell way out of the money put option strike prices that are way down here. So that gives us a buffer. We were in Cisco. We had a trade, a put sell trade on Micron, which we got out for a scratch trade because once we saw the market coming off, moving averages turning down, crossing over each other to the downside, that is a key indicator that it's time to get out of any bullish positions. When you sell put options and put option spreads, that's more of a neutral to bullish strategy. You want to get out of trades when you start to see moves like this. So we got out here, somewhere around here, and then the markets just has kept going down. Micron's kept going down. So we got out at a good time, got out of scratch, and the market or the Micron looks like it still wants to go down. So, we look at price patterns. We look at the moving averages, the way the moving averages are trending. Are the moving averages moving down or are they moving up? And when you're bullish, you want to see moving averages moving up. So that's just some of the things we look for. I'm a big chart guy, so I always watch the charts to see what they're doing to let me know what kind of trades to get into. So now let's talk about our options trading education for today. I'm specifically targeting option buyers because I want to tell you about the three biggest enemies to your options trading issues. So if you're an option buyer and you're having trouble, having profitable trades as an option buyer, here's the three main enemies to your option buying troubles. Number one is time decay. We're going to go over each one. Time decay, high volatility, and the wrong strike price. Let's talk about time decay first for a minute. And we'll go to ivolatility.com. We're going to look at an options calculator. We're going to show you why time decay, volatility, and wrong strike price is an enemy to any option buyer. Now, when we talk about time decay, this is a concept within options trading. Time decay is the issue that for every day that an option is in existence, it will lose a little bit of its value every single day due to the sheer passage of time, right? Time is just one of the elements that help make up an option's price, and each option has an expiration date. So as you move closer to the expiration date, that option will undergo what's called time decay. And as each day passes, the option loses a little bit of its value every single day. And I've used this example before, this analogy. You think about an ice cube that's sitting out on the counter in your kitchen, that at first you won't really see any melting of the ice, right? But then as it moves on, then you start to see the ice cube melting away. It's the same thing with options prices. They start to melt away every single day that they're in existence. And throughout the day, intraday, they start losing value. So the shorter time that's left until expiration, the faster the decay will happen. Think about an ice cube. Those last few minutes, it starts to melt really, really faster than at the beginning. It didn't seem to melt very quickly. But as it moves on, the ice cube starts to melt faster and faster. It's the same way with options trading. At first, when there's a lot of time left before expiration, they don't decay as much. But as it gets down to that last month, within the last 30 days, the option loses a lot more of its value very quickly. And let's show you why that is. So we're in ivolatility.com, and we're using their basics option calculator. This is all free stuff. And right now we've pulled up Microsoft, and we're going to look at Microsoft options, and I'll show you how time decay works. So on the left side here, you've got the inputs into the model, and then on the right side here, it will price out the call option and the put option along with the Greek values, the delta, gamma, theta, and all that. So we're looking at Microsoft finished yesterday at 213.02 per share right here, and we're looking at the money strike, which is a 212.5 puts and calls. And let's change the expiration date to the September 25th. Give us a little time. That's a little bit more than a month from now. 34 days until expiration, and you've got the call option and the put option. Roughly the same price. The call option is a little bit more expensive because it's a little bit more in the money, barely. So let's focus on the call option. The value of the call option is $7.95 roughly per contract. Okay, that's with an expiration date of 34 days till expiration and the volatility of 29.61%. We're going to talk about volatility as well as our second enemy for option buy. So with 34 days left, the value of the call is $7.95 a contract, and theta is what you want that can tell you how much that option will decay per day. It's 11.3 cents per day. So tomorrow, this option, just because of the sheer passage of time, will be 11 cents per contract cheaper than it is today. So let's change the days to expiration, take it down 10 days. Okay, before I hit calculate, I want you to see what's going to happen. The option price is starting at $7.95, and 10 days later, without anything else, nothing else is changing here. We're going to calculate the option price has just lost about $1.50 per contract in value just because of the sheer passage of time. We haven't changed the price of the stock. Let's go back for a second, and we will. The volatility is at 29.61%, so we'll change that as well. I want to make sure everyone's aware of that. We change this to 34, and we keep that at 29.61, and hit calculate. Oops, I'm sorry. Go down 10 days. I want to keep this at 29.61, so we're not changing anything else except the days to expiration. And it's starting at $7.95. Calculate. It's losing over about $1.25 in value just from the sheer passage of time in 10 days, right? So that's an enemy to an option buyer. If you're trying to buy short-dated options within 30 days, the value of that option is going to change very quickly if the stock doesn't move in your favor. Now, if the stock moves in your favor, that's going to offset part of that time decay. But if you have a stock that's just meandering around and not moving to where you need it to be, the sheer passage of time is a killer to your option trading. Now, let's move out now. The actual expiration date is another factor in how fast time decay works. So let's move out to September of 2021. We'll calculate the option price. So now the call option is worth $29 per contract, a lot more time. So the longer time you have, the more expensive the option price will be. But let's talk about the theta and the time decay in this case. In this case, you're only losing 3.8 cents per contract per day. So there's less decay the longer there is until expiration, right? So the call value is $29.19 a contract. Let's take this down by 10 days, 381, and we know that the volatility is 33.67. We'll change that back. So we're only changing the days to expiration, $29.19 per contract, hit calculate, and we've lost about 35 cents contract in that call option over a 10-day period, right? So if you're losing almost 4 cents a day, times that by 10 days, that's about 40 cents you're losing over that time period. So theta can tell you how much the option will decay per day. Now, the 10 days from 391 days to 381 days, you lost less value to time decay because there's a lot of time left. There's 381 days left. But remember, when we looked at the September 25th, 2020, you only have 34 days left. The time decay is a lot greater in those last 30 days before expiration. Now you're losing 11 cents per day just through the sheer passage of time. So time is the enemy to an option buyer, especially if you're trading very, very short dated options. If you're not sure where the stock is going, if you don't have a good handle on where the stock is going, buying short dated options is not a good strategy, because you're gonna lose value just because of the passage of time. So you have to be really, really good at picking stock direction, and the stock has to move very fast to offset this time decay. So if you're not sure where the stock is going, or you need more time because you're just not sure, choose longer dated options if you're buying options to give yourself more time to be right. A lot of new option traders don't understand that concept of time decay, and they want to buy short dated options because they're cheaper. They cost you less dollar-wise. Stick to longer dated options. Give yourself at least 3 months, because you never know which way stocks are going to go. So give yourself more time to be right. So back to our little list here. That is number one. Time decay is an enemy to option buying. Number two, high volatility. Let's go back to our calculator here. You want to try to buy options when volatility is on the lower side. We can go back to the VIX, right? The VIX tells us what volatility is doing and how it has a direct effect on option pricing. When option prices are high, when volatility is high, option prices are higher as well, because volatility has a direct effect on the price. And when volatility comes down, option prices are cheaper. Let's see how that works in real time here with the option calculator. So let's go back. So we're looking at the September 25th date. We got 34 days expiration, and the call options were $7.95 a contract. Let's bring the volatility up let's bump it out to 10%, which is not unheard of, especially what we've been seeing lately. And we'll see how the call option changes from $7.95. Now it's worth $10.37 a contract, just because we changed the volatility number. Price stayed the same, stock price stayed the same, days of expiration stayed the same. We just raised the volatility. So it bumps up the price that you will pay for the call option and the put option as well. They both move. Put option, call options move according to how the volatility moves. So it affects both calls and puts. And Vega is a number here that tells you the change in the option price in a change in volatility numbers. So if you want to know what will happen to your option price when you change volatility, you can look at the Vega number. Okay, so that helps you there. Volatility, big effect. So if you're going to buy options, you want to buy options when volatility is cheaper. And you can actually look at the volatility of each stock itself. Let's see what we could do here. I want to look at, hang on for 1 second. So if you go back to the homepage of buyvolatility.com, which is where I'm at, you can click on the volatility chart. This is just a stock on their homepage. And what it'll do is you can find the volatility of the stock itself. So let's go put in Microsoft, because that's the stock that we've been looking at. Click on the volatility chart down here. I've shown this before. Volatility chart shows us how Microsoft volatility has trended over time, over a 1 year period. We've got two lines. We've got implied volatility and historical volatility, and they move in tandem with each other for the most part. Here's the main part of the coronavirus. Volatility just spiked, and now it's come back to about 30%, which is still a little high from Microsoft. Microsoft's volatility is usually somewhere between 15 and 25%. You want to look over the long term. Now it's about 30%. So buying options up here, Microsoft, it would cost you a pretty penny, and the stock would really have to move far and fast in order to offset that high volatility. Now it's come back down closer to its normal range. So if you're buying options on Microsoft, you're not doing so bad if you're buying them down here, because volatility has come back down. So that's a big thing about option buying. You want to make sure that your volatility is on the cheaper side. So we're back at the calculator here. So once again, we can take volatility back down 29%, and you'll see how both put option and call option prices change. They drop. So volatility, huge deal when you're option buying. Want to try to buy options when volatility is cheaper. For us as option sellers, we like when volatility is high. We get more money when we sell them. So we look for higher volatility environments when we are selling options. Going back to our little chart here, our spreadsheet with the enemies to option buying. Last thing is the wrong strike price. That is a big deal for option buying. A lot of new option buyers pick out of the money strike prices because they're cheaper dollar-wise, very cheap, and they would just want to buy cheap options and try to make a lot of money. But biggest thing is that you have to know where the stock is going. You have to have an idea where the stock is going, and if stock doesn't make the move, you're going to lose. I've always said the best option strikes to buy if you're an option buyer is a deep in the money option, because that moves in tandem with the stock and it's not prone to as much time decay or volatility. It's not as doesn't move as much because you change volatility or the time, which is good. So deep in the money option. So we're looking at Microsoft here. It's at $213. If we change the strike price to, let's say, a deep in the money 170 call option, we're going to see the value of that call option. It's $43.42 per contract, okay? And if we change the volatility and the day's expiration, we're not going to see as much change because a deep in the money option doesn't move as much when you change volatility and day's expiration. So that's why we like to trade deep in the money options, because they're not privy or prone to the changes in these two things right here. So you can see Theta and Vega are very small, 4.8 cents and 3 cents per contract. So if we change the day's expiration to 24 days, we lose 10 days. You're not going to see this option value change too much. It'll change a little, but not as much as an at the money option. So right there. So it's still only lost about 20 cents or so. And we dropped the day's expiration by 10 days. So the deep in the money call is not going to be affected as much by time decay. Let's take it back to 34 days. Brings us back to $43.42. Let's change the volatility. We can move this up. We'll take it down about 10%, 31.8, and you won't see this change too much either. Okay, dropped about 30 cents a contract. Not a lot of movement, not a lot of change due to the change in volatility or the day's expiration. So deep in the money option strikes do not get affected as much by the volatility and days of expiration. But at the money and out of the money options change dramatically to changes in time and volatility. Let's use a strike price of the 220 strike, which is out of the money. So right now it's worth $4.50. Let's take this down 24 days expiration. You're going to see that change dramatically. It lost over $1 in value. So the at the money and out of the money options has a big effect when you change days of expiration and volatility. So there you go. You've got the three biggest enemies to option buying: time decay, high volatility, wrong strike price. You want to think about these things before you buy any option, right? So remember, the shorter the expiration, the faster the option will lose value. The higher the volatility, the more you're going to pay for that option price. So look at a volatility chart. See where the stock is on the volatility scale. If you're buying when volatility is low, you're going to do better. You'll have a better chance of winning when you are an option buyer. And the wrong strike price we just showed. If you're buying options, buying deep in the money options is the best way to get around time decay and high volatility. But I understand that deep in the money options are a lot more expensive. They cost a lot more. So that's why people gravitate towards the at the money or out of the money options, because they're cheaper for your wallet. So you have to decide what's right for you. But these are the three biggest enemies to option buying. Back to the charts. That will do it for me today. I hope this lesson has been helpful to any of you prospective or current option buyers out there. If you like this video, give me a thumbs up on the YouTube channel. Don't forget to subscribe to the YouTube channel. You will be alerted to whenever I put out these new videos once a week. And lastly, we go to our Smart Option Seller homepage. We will show you what we have here. We go to Put Selling Basics. If you want to learn more about what we do at Smart Option Seller, click on the Put Selling Basics. It's our free ebook on how to sell put options. It's a great guide. Learn about what we're doing here at Smart Option Seller. And once again, our services tab, Smart Option Seller, we've got 2 newsletters and one-on-one coaching. If you ever need help, we can certainly help you. So that'll do it for me today. I hope everyone has a great weekend. Enjoy your next week, and I wish everyone successful trading. This is Lee Lowell signing off.